Hello. Today we're going to learn a skill that can meaningfully lift returns in the US stock market. Same period, same market. Yet one name is up about 50% while another is down about 30%.
Why?
Often because investors never learn the business cycle and how money rotates across sectors. There's a concept called sector rotation. Historically, certain industries lead when the economy heats up and others hold up better when it cools. The pattern repeats. In this lesson, we'll apply the same 11-sector framework global investors use, tuned to how the US market actually behaves, and build a practical chart habit for reading in advance. Where is the money flowing right now? Look at Apple's weekly chart on your screen.
사이클즈 리피트. 리커버리 그러면 익스펜션 그러면 픽 그러면 슬로다운.
Multi-year swings like this show up again and again in market history. The key point: the winning sector changes at each stage, like different clothes selling in different seasons. Recovery: financials often wake up first. When the Fed cuts and rates ease, lending picks up and liquidity returns. Next, materials, steel, chemicals, cement-linked names tend to firm as commodity demand and prices recover. Expansion: growth areas like technology and consumer discretionary, think autos and big-ticket purchases, often lead. Companies invest more and shoppers spend. A sharp Fed hike cycle, though, can flip that leadership fast. When bearish signals stack up, rotate toward defensives, utilities, healthcare, consumer staples. People still flip the lights, buy groceries, and fill prescriptions. That handoff is the basic idea of sector rotation. On Apple's daily here, the US concentration story jumps out. The top 10 S&P 500 names often account for roughly 35 to 40% of the index. That is still high, and in AI-heavy years the Mag 7 alone can push near 30% plus of the whole index.
이트 게츠 사업포온 나스닥.
A handful of mega-cap tech and semiconductor leaders can dominate day-to-day index moves. In plain English, when those names rise, SPX and NDX usually follow. When they fall, the indexes often fall with them. So US sector rotation is often, in practice, a dance between mega-cap tech/semiconductors and the rest of the VIX map: financials, industrials, energy, staples, utilities. Semiconductor trait: tight chip supply can send prices and earnings up together. Oversupply can crush them. Historically, that swings on a multi-year cycle, often talked about as roughly 3 to 4 years. Auto/consumer discretionary trait, sensitive to the global and US cycle. Strong jobs and easy credit support big purchases. When the Fed hikes hard, buyers delay financed cars and demand can drop fast. On the technology select sector to XLK, weekly, remember the Jigsaw 11. Information technology, financials, healthcare, consumer discretionary, industrials, energy, real estate, consumer staples, materials, utilities, and communication services.
프랙티컬 팁. Put the S&P 500, SP, SPX, beside A few sector ETFs XLK, Tech, XLI, Discretionary, Autos Retail Mix, XLF, Financials. Side by side, you see who is leading. Example: tech prints fresh highs while financials go nowhere. That can be an early hint financials' turn may come later, not a buy order. Go deeper with relative strength. Divide A Tech ETF price by A Discretionary ETF price.
Rising line equals tech stronger than discretionary. Falling line equals the opposite. Park that ratio in its own pain, and sector tug-of-war becomes obvious. As of June 2026 reference framing, AI demand and tight chip supply have favored IT, but the textbook pattern says that when rates start rising again, financials and utilities often stage a countermove. Also watch leading macro prints, U.S. GDP, ISM manufacturing PMI, and consumer spending often telegraph earnings shifts months ahead. For chips, rising drum spot prices can flag better memory earnings. High wafer utilization usually means strong industry demand. On the Ford F daily, a familiar U.S. auto/discretionary name, catch rotation chances by watching 3 signal types. First, technical. Which sector just broke a 52-week high? That often means crowded money is already in, pullback odds rise. Sectors near 52-week lows can offer larger recovery room if the cycle turns, still not a guarantee.
세컨드, 펀더멘탈. How are S&P 500 earnings growth rates shifting by sector?
Stronger growth sectors often lift with price. Deteriorating ones often correct. Example, if auto sector average operating margins rise year over year, the fundamental tape looks constructive. Third, global/cross asset. Watch S&P 500 sector trends and Fed path together. If U.S. IT leadership cracks on the chart, semiconductor-heavy names often weaken with it. Soft U.S. auto sales prints can pressure discretionary exporters and domestic dealers early. Overheat warning. When a sector's PE sits above about 150% of its 5-year average, treat it as an elevated valuation caution. Price has run far ahead of earnings. Stay patient until a profit-taking phase cools the tape. On the utilities, select sector to XLU, daily. Watch what happens when growth signals fade. Portfolios often shift from offense to defense. Consumer staples, food, beverages, household basics, and utilities, power, gas, keep selling even in soft economies, so prices can be relatively steadier. Like a coffee that still costs about $3 to $4.50 whether the cycle is hot or cold, power and gas demand rarely disappears in a downturn. These defensive groups also often pay meaningful dividends. Historically, utilities and mature financials with steadier cash flow have returned more cash to shareholders. Policies differ by company. Always read the latest dividend notice yourself. Mid-2020s U.S. tax framing. Qualified dividends from many U.S. companies often face preferential federal rates, commonly 0%, 15% or 20% by income bracket, and rules can change. Recheck IRS publications before you plan around after-tax yield. Tip: holding dividend pairs inside a Roth IRA or 401k can change the tax timing on dividends and growth. Contribution limits and rules update yearly. Confirm the current IRS figures and your plan documents before you act. This is education, not tax advice. On the S&P 500 weekly, the core idea: different sectors lead at different cycle stages. Reading those handoffs on the chart early means you can move before the crowd, still with risk, never with guarantees.
A. 콘크리트 로테이션 스케치. 리커버리 힌트 그러면 린 파이낸셜즈 앤드 매트리얼스 퍼스트 그러면 익스펜션 그러면 시프트 투워드 IT 앤드 인더스트리얼즈 그러면 소프트 랜딩 오르 다운턴 시그널즈 그러면 무브 투워드 스테이플 앤드 유틸리티즈.
That portfolio handoff is what people mean by sector rotation. U.S. market trade. Megacap tech and semiconductors often drive a large share of index moves. Keep watching their global supply, earnings cycles, and tech trends if you care about index-level returns. Next lesson preview: how to read daily, weekly, and monthly charts together. Multi-time frame trend work helps filter noise and sharpen entries and exits. This lesson is for education only and is not investment advice. Every trade is your own responsibility. Thanks for watching. See you in the next lesson.